Avis Budget just hit $848 this morning. By close, it was trading at $443. That's a $405 swing in a single day. And every Wall Street analyst covering this company, Deutsche Bank, Goldman Sachs, Morgan Stanley, Barclays, still has a price target at under $150 per share. That means that even at close, this stock has over 70% implied downside, according to the people who supposedly know it the best. So the million-dollar question is this the first crack in the short squeeze that's finally starting to run out of fuel? Or is this something else entirely? Because there's one thing about today's reversal that almost nobody is really talking about. And in my opinion, that changes how you read into this whole situation. This is compounding alpha. I cover stocks the way they deserve to be covered, with the fundamentals, the full picture, and a clear point of view. If you like this kind of content, drop a like and even subscribe. Without further ado, let's get into it. Here's what you need to understand about Avis Budget before you touch this stock. This is not a misunderstood growth company. This is not even an overlooked turnaround. This is a fundamentally broken business that just happens to be on fire right now. On February 18th, Avis reported full year results. Net loss of $995 million for the fiscal year. Revenue down 1.2% year over year. Free cash flows negative at $1.57 billion. The analysts estimated Q4 EPS to be around negative 23 cents per share, but the actual number was negative $21.25 per share. That's a massive disconnect between estimates and actuals. My goal by the end of this video is for you to understand why this stock actually hit $848 this morning and why it gave back 40% before close at the end of the day today. And to try to help you answer the question that is today the beginning of the end, or is this just another chapter in the wildest squeeze the market has seen in years? The morning after their earnings report came out in February, their CEO, Brian Choi, got on call and said, and I'm quoting him directly here, "We fell significantly short of guidance. That's unacceptable, and I had no excuses to offer." And 2 months later, the stock hit $848 a share. When I saw that chart today, I had one thought. I've seen this somewhere before, and that is exactly what worries me. I took a look at their balance sheet, and here are some of my main key takeaways. They have $6.1 billion in corporate debt. They have $25 billion plus in total obligation, and they have negative shareholder equity at $3.1 billion. Their interest coverage ratio is sitting at only 0.7x. That means they're not even able to cover their interest payments with the operating income they have right now. So even at today's closing price of $443 a share, you are still paying 50x forward earnings for a rental car company. The sector average is 12 to 15x. 9 analysts are covering this company. Large majority of them have either a sell or a hold rating. The median consensus is $135 per share. That's over 70% implied downside from today's closing price. And here's a structural problem that makes this bear case feel airtight. GameStop peaked at $483 a share. It fell 92% in 3 weeks. GME's short interest peaked at about 140%. Avis right now is approximately 54%. The squeeze here has to be real, but today showed exactly how fast it can start going down the other way. But here's the thing that makes this different than the GME situation. On March 27th, Avis filed a prospectus to sell up to 5 million new shares at whatever the market price was at that time. They have the ability to make the sale through Barclays, JP Morgan, Morgan Stanley, and this morning at $848, that authorization was worth about $4.2 billion. Management watched the stock hit $848 and did not pull the trigger. GameStop never had this play in their book. And here's why that changes the story. 2 hedge funds, Penwater Capital and SRS Investment Management. Between the 2 of them, they economically control 108% of Avis's tradable stock through shares and total return swaps. Penwater alone holds 12.3% of the company. They bought 425,000 shares at $94 a share. And at today's close, they're up over 400%. And here's the part that nobody caught. Barclays downgraded the stock to underweight on Monday at a price target of $150 per share. Barclays is also one of the banks authorized to sell shares under the ATM offering. That same firm telling clients to sell gets paid a commission to sell new Avis shares back to the market. Here's another underrated part. Despite the losses, the debt, and the guidance miss, the underlying business is operationally stabilizing. Adjusted EBITDA is up 19% year over year to $748 million in FY25, and management guided $800 to $1 billion EBITDA for FY26. Q1 2026 earnings will be on April 29th, 7 a.m. Eastern. That is a real catalyst here. Not the squeeze, but the earnings call. The valuation verdict is this. This is a trader stock. This is not not an investor stock right now. Today proved that in real time. And here's the honest risk you need to hear. Today was a preview. At $848 a share to $443 in a single session, that is what unwinding looks like. The moment Avis begins to sell their ATM shares, and we will know exactly when they do because they gotta file a Form 8K, the supply scarcity that powers the squeeze is gone. 5 million new shares into a 10 million share float does not end well for anybody who bought above $400 a share. GME fell 92% from its peak. Avis has better fundamentals than GME did, but today's reversal is a data point that you just can't ignore. My personal opinion is this squeeze is not over. The float trap is still intact. The ATM window has not been used yet, but today changed that framing. This is no longer a question of whether the squeeze will eventually end. Today showed us that it can give back 40% in a single session when it does. Here's one thing to watch. April 29th, 7 a.m. Eastern. If Q1 revenue comes in at above expectations and the ATM offering is still unused, this squeeze has another leg. If management announces they've been selling shares or Q1 fundamentals disappoint, today's reversal will be a warning shot for that. Look, I don't own car, but I won't be watching April 29th like a hawk. Are we witnessing history with the next GameStop that'll end in a crash? Or does this ATM offering make this one actually different? If you're a bull, a bear, or a trader of this stock, please let me know. This stock is genuinely fascinating. And if you like this high-level type of analysis and a TLDR on what's the most interesting thing going on in the market, I'd appreciate it if you could drop a like and hit that sub button. But nonetheless, I wish you all the best. And remember to stay hydrated. Take it easy.